Thank you, Amy. It's a pleasure to be here today as part of today's webinar in which we'll present some best practices for cash flow forecasting and budgeting. And I looked over the list of attendees just prior and see that we've got a very diverse group of people attending today. We have some CFOs and controllers of large and mid-sized companies and some small business owners from all types of industries and nonprofits. And I'm sure you're all using a wide range of software and in various types of financial situations. So I hope that all of you will find some part of today's content relevant to you and come away with a few things you can implement in your organizations. And since we're near the end of the year, maybe some of you are just here because you need the CPE, and that's great too. Happy to help you out. So here are today's presenters. The three of us that you see here were part of the business outsourcing and strategy group at Eide Bailey. To briefly describe what our department does, we do outsourced accounting and payroll services, including accounts payable and process improvements, relieving those administrative burdens from our clients. And along with that, we provide virtual CFO and controller services, advising management with financial modeling and decision making. All of that while using the cloud and technology that helps us work with our clients a little more efficiently. So my name is Dustin Wheeler. I am in the Lehi, Utah office of Eide Bailey, and I work with our partners, staff, and clients across the country with the focus on leveraging accounting technology. And after me, you'll hear from two of our managers who I've really enjoyed working with. Both of them have great experience as outsourced controllers and advisors. They're both very talented with their accounting skills and also finding ways where our clients can improve what they do. So Heather Hootery, she's in our Fargo, North Dakota office, and Jackie Brooks is in our Tulsa, Oklahoma office. So spread out a bit over the country, but we can all come together here today and present this webinar. So what you see here also is our contact information. If you have questions, feel free to reach out to any one of us. And if you'd like to put questions in the Zoom Q&A, please do that also. We'll monitor it as we go through the webinar, and if we have some time at the end, we'll answer some of those questions live. So we will address your questions. It may just take a little bit of time. So, oh, I need to go back one slide, Amy. I guess it was a little click happy there.
You can just use the arrow key on your keyboard.
Previous. There we go. Great. So during the COVID-19 pandemic, my family has had to adjust some of our activities that we do together. And that means that we've had to, unfortunately, miss out on some activities we've enjoyed, but we do more of others. And so one of the activities we've done a bit more of in 2020 has been board games. And I think we can all learn lessons about managing cash flow from board games and some video games as well. But one of my favorites that really sticks out in this category is Monopoly, which I've enjoyed since I was young. So what is the objective of the game Monopoly? Well, it's not to try to have the most money, although that certainly helps. But the way you win is by giving your opponents a cash flow problem and driving all of them bankrupt. So I'd like to tell a personal story here. And you're all going to think I'm really mean after I tell this, but it's all in good fun. So I was playing Monopoly with my two oldest boys, and my younger son, who is 9 years old, he desperately wanted a Monopoly, but 3 properties of the same color. And you might know how 9-year-olds can be. He's like, Dad, can we trade? Can we make a trade? So I drive a hard bargain with him and I say, sure, I'll give you Pennsylvania Avenue, but I want St. James Place and I want $400 on top of that. Well, my son agrees, and he's very excited that he's got a Monopoly. And then he buys a couple of houses to put on it, and then he's left with like $10 of cash. And when he lands on other properties, he has to start foreclosing to pay the rent. And the game really penalizes you when you try to do that. So he goes on to go bankrupt, and he loses the game, and he's really disappointed with the outcome. But afterwards, he and I had a good talk. We had a heart-to-heart about cash flow of all topics. And it was great to see that he learned his lesson. And so the next time we played, he improved how he managed his money. Now, what's great about this is that we can learn these kinds of lessons in games where no real money is lost. And I hope for my kids, these lessons will translate into the real world someday. but it's heartbreaking to see businesses fail and the impact it has on employees and business owners and their families. Now, what's great about this is that we can learn these kinds of lessons in games, but what I hope we can accomplish in today's webinar is to help you learn some strategies and best practices for forecasting cash flow and budgeting. And in some ways, a cash flow crisis is kind of like stepping off the curb and getting hit by a bus. If you don't look both ways, you can be blindsided. But if you're regularly forecasting your cash flow and establishing a budget, you may see what's coming and you might have time to evaluate your options. So going back to the bus analogy, maybe you take a step back on the curb, or maybe you try to wave down the driver. You've got time to do that. And similarly, in a business, if you know what's coming, you might have time to get a loan or funding, or make an effort to change the timing of your receivables and payables to hopefully avoid that bus of a cash flow crunch. So let's start off here with the cash flow equation. We start off with how much cash is in the bank today, right now, and we add to that cash inflows. Notice that this equation is not the same as a profit and loss or income statement. The cash inflows include income that comes in the form of received cash, such as deposits from credit card, merchant services, electronic payments, paper checks. But the definition of cash inflows includes a lot more than just income. Now, this could be money from loans or lines of credit, the sale of fixed assets, or capital contributions from owners. The defining factor is that the payments aren't cash flow until you have access to those funds in your bank account. Then we subtract out cash outflows. This could be checks you write, or expenses on debit cards. But similarly, the definition of cash outflows includes a lot more than just expenses. It could be payments you make for a loan, but remember that both principal and interest count for cash flow purposes. It could be distributions to owners. To sum it all up, outflows of money aren't considered part of the cash flow equation until they leave your bank account or they leave your pocket. So you do this very simple math equation and get to what will be your future cash balance after all these events have occurred. So this is super simple math, right? Well, it's a simple equation. And I was a little click happy again. Sorry, I'm going to go back to the previous slide here. We do this very simple math equation, and we get, but the art of cash flow forecasting can get a lot more complicated. And the truth is, it's a real puzzle to decode when money is likely to come and go from your bank accounts. You have to take into account things like seasonality, and you have to worry if an outgoing payment happens before money comes in to cover that expense. So there's a lot of questions to consider. When will my customers pay their invoices? Should we pay off our credit card? What if we buy a building, or what if we buy something else? Well, you suddenly have a ton of variables to consider in how this whole thing is going to work. And the tricky part here is predicting the timing of when these events will occur and evaluating your alternatives. So there is software out there that can help do the math. It can analyze receivables and customer payment history to estimate when the collection of receivables is likely to occur. And software can identify what transactions are recurring and likely to continue to occur. But there is still a human element where you, as the business owner or the accountant or the CFO, whatever you are, and you need to use your understanding of the business to answer some of these questions. So I'll share a few statistics here, which are really quite sobering. CPE question just popped up, if you can answer that. But to be upfront about these questions here, these statistics, I didn't research them all myself. I got all of these statistics from a book called Pandemic Cash Flow. Interestingly, this book was written and titled before the COVID-19 pandemic, so the title is actually quite coincidental. But just reading through these statistics here, half of all businesses will fail within their first 5 years, and cash flow issues are the leading cause. 30% of businesses will fail due to cash flow issues alone. 82% of businesses that fails places blame on cash flow. And according to Fin Pacific, 70% of businesses that fail are profitable when they close their doors. Now, I'll pause here because I think this one deserves some commentary. How can a business fail while it's being profitable? Well, you can be profitable on paper and have $1 million in receivables. So revenue is not the issue, but the problem is not having cash on hand to cover your costs when those expenses need to be paid. Or maybe a company spent too much money on equipment or fixed assets that frankly they couldn't afford. And the final one here on the slide, further, they note that businesses only planning once a year have a 36% survival rate over 5 years versus those planning monthly, which have an 80% survival rate. So there appears to be some correlation to business survival if you're monitoring cash flow often as opposed to less often. Now, as terrifying as these statistics may be, the greatest tragedy is that those aren't just numbers. The numbers represent people. These are business owners with their life savings on the line, the families they support, the staff that need their paychecks to keep their households running. Here we go. Are you at risk for a cash flow crunch? So here are some questions to ask yourself, which I got from the same book, Pandemic Cash Flow, and you can download from a link here I've put into the chat. So this link goes to Pandemic Cash Flow, and you can download this cash flow scorecard and evaluate your risk of being hit with the cash flow crunch. So how do you get paid? Well, the lowest risk being cash payment, since you have the cash on hand immediately. Conversely, the highest risk comes from sending your customers invoices which are paid later, since you don't have the cash on hand to pay bills. Not only are you forced to await payment, you're relying on your customers to pay their bills on time, if at all. Number two, how big are your individual sales? Well, numerous smaller purchases can lower your risk since your cash flow is spread out over a larger number of transactions. And losing a single sale will have a lower impact on your business than a large transaction. Number three, how often do you get paid late? The longer a payment sits, the more likely it is that you will not receive the full payment, or even worse, that the customer may simply just refuse to pay. If this is a problem for you, then consider having more frequent contact with your customers in a polite and professional manner and ask for payment. As simple as that. Number four, how large is your monthly budget? So think about your recurring expenses and how long you can go during lean months and still keep your doors open, and how quickly you can scale back expenses during a lean time. Number five, how do you pay your largest expenses? Although bills that need to be paid at a later date need to be carefully tracked, ensure that you're paying them on time, but not necessarily early. Number six, how often do you pay your bills past the due date? Sometimes bills simply need to be paid late in order to prevent your business from closure, but keep in mind that oftentimes paying bills late will have a negative effect on your business. It can hurt your reputation. It can lead to late fees, late deliverables, fired clients, price increases on future work, refusal of the contractors and suppliers to even bid on a job. So be cautious with that. How fast are you growing? Number seven. Growth is a good thing, right? But growing too fast has been the root of many business failures. Number eight, how do you fund expansion? There may be circumstances where funding growth through cash flow is your best bet. Other times, outside capital, such as debt or investment, may be the strongest move for your business. Number nine, how big are your savings? Well, savings give you that safety net, and the more cash you have on hand, the lower your risk of a shortfall. On the other hand, cash that is just sitting idle in a bank account is doing little for your business. So there's certainly a balance to be had there that you can plan for, and maybe your accountant can help with that. Number 10, have you ever missed paying yourself? Well, if you're unable to pay yourself on a regular basis, or even more extreme, investing money into your business to keep it afloat, you're probably in a very risky situation. So hopefully going through these questions, you can evaluate your risk and definitely go through that scorecard and come up with what your score is. So here's a frequently asked question we all get. How much of a cash reserve should you have? And I don't have a one size fits answer to that. It's going to depend on your type of business, size of business, how at risk you are. Obviously, if you're more at risk after assessing the questions from the previous slide, then you may want to have more cash. reserve than otherwise. But we can take a look at some averages out there. What you see down below in yellow is a link, which I'll also paste into the chat for convenience. You can click on that link. And this link is a link to JP Morgan Chase, a study that they did done before the pandemic, published back in September 2016. So again, I'm not recommending these figures of what's right for you, but you may just be able to compare yourself to others. So the survey measured the number of cash buffer days, and that's defined as the number of days of cash outflows a business could pay out of its cash balance where its inflows to stop. So if you've got that PDF open with that link, on page 6, there's a really interesting chart on there. So if you're following along, the number of cash buffer days vary significantly by industry. So with restaurants, the median is only 16 days. And what's really unfortunate is that this industry was hit so hard with COVID-19, and on average, we're the least equipped to weather the storm. So they face some challenges, a high labor to sales ratio and low margins, and all of that may contribute to that low median. And on the other side of the spectrum, we have real estate with a median of 47 days. So what's also interesting here is you see on that bell curve, the 25% of businesses have less than 13 days of a cash buffer. Now that doesn't really give you much of a margin for error. So that's something definitely to consider there. So I suggest you all go in and read the survey. It's got some interesting statistics in it. But with that, I will pass our presentation now to Heather Hootery.
All right, thanks, Dustin, for getting us off to a great start today. I've heard those statistics quite a few times myself before, and it just never ceases to scare me. So, but these next few slides, we're going to build on some cash flow topics a little bit more from how Dustin got us started. And we're going to start with this quote from Michael Dell, where he says, "We were always focused on our profit and loss statement, but cash flow was not a regularly discussed topic. It was as if we were driving along watching only the speedometer when in fact we were running out of gas." And I can relate to this one both personally and professionally. Personally, because I'm always the person that's saving that chore of filling up my gas tank till tomorrow morning, which never ends well. But professionally, I'm having this conversation quite often with clients and trying to help guide how to prevent an empty gas tank. So we're going to get started with some best practices here. First on the list is you'll want to know your cash burn rate, meaning the amount of cash that you need to consume over a period of time. And when you're calculating this number, make sure you're taking into account not only your fixed costs, but also your variable costs so that you can flex those variable costs up and down with your revenue projections. Second one being monitor frequently. And I don't want to say that it completely defeats the purpose of taking the time to build out a cash flow forecast if you're not going to keep it updated frequently, but it's just not enough to be looking at it quarterly or less than that. I would say try to make time for that on a weekly basis. And the next one is one of the most important ones, being invoice promptly and collect quickly. I've seen clients on either side of the spectrum that are really good at one or the other, but getting good at both is going to be the most beneficial for your organization. And I can't stress that enough of how much of a high priority this needs to be. And reviewing your purchasing policies. This one is simple but effective. If you can work with your vendors to better align your cash outflows with the way that you collect your cash on whatever terms that you can come to agreement with. So even if it's as simple as going to a local store that you frequent a lot and having setting up an account rather than swiping your debit card every time you go there, that can help shorten the gap between cash coming in and cash coming out. And now my favorite one, use technology other than Excel if you can't. And I do love a good Excel spreadsheet, so don't get me wrong with that. But now that I've had the opportunity to work with several different cash flow tools, I've realized that while they're not going to give you 100% of the flexibility that you can get with Excel, They do make it a lot easier to automate and collect your data. So that sacrifice and a little bit of flexibility is often worth all the time savings that you'll get with using those automated tools. And the last one is just remember to have a trusted business advisor. You don't have to be doing all the work for this on your own. Have somebody that you can have a candid conversation with that understands your business and can help give you some valuable perspective on what you're working on. So now if you're looking for cash currently, where I typically start looking is by reviewing your receivables. So if a previous manager of mine would always say, the squeaky wheel gets the grease. And what she meant by that is it's important to stay in touch with your customers and remind them that as their invoices are coming due, and even calling them as soon as they become past due. And I do say call them on purpose. I feel like it's very, very easy for a person to ignore an email. And if you can get them on the phone and actually have a conversation with somebody, it can oftentimes be a little bit more fruitful. And of course, being kind, professional, courteous, but also firm with them that they do need to pay. Another interesting way to look at your receivables is more along the lines of metrics. So if you're looking at your receivable days over time, keeping an eye on that metric, and if it's starting to creep upwards, starting to think about what you can do to change that. So thinking of things like, is it time to offer different payment terms to your customer, breaking up the larger payments over a period of time into smaller, more frequent ones? Or if you're not allowing customers to pay via credit card already, maybe it's time to offer different payment methods. It might be worth that merchant service fee at this point to just expedite getting cash in the door. Or it could even be as simple as looking at what your staff is working on and reallocating more of their time to managing the collections process. Another good place to look for cash is if you're carrying inventory and starting to analyze what you have on hand. Slicing and dicing your data at the SKU level can be a really interesting exercise if you're not already. Looking at the makeup of the inventory that you have on hand and looking for things that stand out. So things like, do you have a high volume of SKUs that all are made up of low margins, or if there's any particular SKUs that aren't turning? And when we think about monitoring trends with inventory as well, that can be really interesting and beneficial exercise to work on. So if you used to turn, this would be an example, if you used to turn inventory in 30 days and now you're starting to trend closer to 32 days, that might not seem like a huge difference at the time, but I would encourage you to turn that around and look at it in a dollar value. And calculate what the dollar value of those 2 days means for your cash position. And if you're still comfortable with that number, great. But if not, perhaps now would be a good time to start, again, looking at your staff time. Maybe it's worth allocating more time towards your inventory management, or in some cases, we've even seen it be enough cost savings to merit a whole new staff person. These last 2 points we won't spend too much time on. We've already touched on them a little bit, but again, remember to negotiate your vendor payments when you can, and work with your banker and establish a line of credit if you find that that might be a good resource for your organization. And just a quick reminder of that polling question that's outstanding. Okay, so now for the fun part, we get to start modeling. And we would start with the base forecast, like Dustin's cash flow equation that he spoke about. So what cash do you have on hand today? What are your outflows and inflows looking like? And when are all of those going to come together? I like to forecast on a weekly basis, but monthly would be okay as well. So once you've got your good base forecast, now would be the time to start thinking about some critical factors so that you can choose what kind of scenarios that you want to look at for what if scenarios is what we call them. And then those what if scenarios we would run side by side with our base forecast to kind of give us how things would pan out in a best case or worst case type of scenario. So when you're trying to think of those factors, I'd want you to think about things that are either unique to your industry or to your particular business. So an example would be, are you project driven, where you could have a delay in your deliverable to your customer that would impact your incoming cash? And then what would cause the delay in deliverable, and keep drilling all the way down to your source event that could really impact your cash flow. So then when modeling out scenarios, each scenario is going to be different for every business, but just for discussion purposes, I'm going to pick on the construction industry to start with. So it's well known that the construction industry typically is running larger projects that span over a period of time. And I watch a lot of HGTV, so I know all about this. I know that there's always going to be those unanticipated costs that you don't expect to incur. And so if that's what you're facing, then maybe you'd want to look at a scenario that shows a what if, or what if a key project falls behind. Or on more of a positive scenario example, maybe you run a small medical practice and you're looking at bringing on another partner, but you want to know what their production goal would need to be in order to cover all of the costs that come along with bringing on another provider. And so that's all a lot of information, and it can be fun and addicting, but also overwhelming to think of all the different possible scenarios that could happen with your business, and it's going to be impossible to capture all of them. So try to limit yourself to just a handful to maintain and keep updated, because you do want to keep these updated, and you do want to make an action plan and have some measurable KPIs to watch, and keep all of your business partners responsible for what their piece of the puzzle would be. And Jackie is going to touch on that when I pass on to her shortly. But I do have one more slide where I wanted to show you all of these in action. Whoops, click Cappy. Okay, so this is just a very simple example from one of the tools that we use. We do partner with several software companies that offer cash flow solutions. So this is just one of them. And here you'll see this top section here is a graph in which it's displaying two different scenarios for that we've put into the system. For the orange line here on the graph is going to be your base forecast. And then the green line on the graph is going to be your if I receive a bank loan scenario. So your what if scenario. And you can see them running side by side over time. It's really easy to compare the two and kind of where you would end up being. And you can drill down to any one of these sections when you're in the tool, see what makes up the numbers and shift some numbers around as needed. And the best part about all of this too is that it just connects directly with your accounting system in most cases. So this one for the example is connected with QuickBooks Online. So it makes it really easy to maintain, and it has some algorithms in there where it will calculate some of these items for you too. So, all right, so now it's time to talk a little bit about budgeting, and Jackie's gonna take over.
I was muted. Thank you, Heather. I'm going to test this real quick. Okay. Whoops, I'm sorry, Amy. Okay, there we go. Yeah, so everybody has a plan until they get punched in the face. And that's what Mike Tyson said. And I think everyone can agree that 2020 feels like we've been punched in the face, the mouth, the head, or other areas of our bodies. In our budgets, our plans for 2020, those definitely took a beating. So in our actions during the pandemic, they have been probably more reactive than strategic, taking our old budget, which now at this point just consists of numbers and numbers that are no longer relevant, and going line by line to see what we can do to make that bottom line more favorable to stakeholders. Okay, but we're here, we're among a pandemic, and we're facing unforeseen market conditions from COVID. So what do we do now? First, just don't panic. And I'm sure everybody has already done that, but going into 2021, let's not panic. We may be hurrying to go back down our expenses and cut each and everything that we can, which expense reduction isn't wrong and can be helpful to eliminate waste, but we may be missing a unique opportunity to find or capitalize on the values within our company. This is a great time to look outside of the box for opportunities you haven't thought of before. So how do we do that? We start by shifting the focus from financial precision to strategic success. Plan for higher performance, not for predictable returns. The goal here is to improve the outcomes for our customers, our employees, our investors, and even our communities. Not necessarily as hitting budgets, but focusing on learning, adapting, growing, because we can't try to predict the unpredictable, but we can be strategic. You'll see here a couple of figures that I got from the Harvard Business Review. They posted an interesting article called An Agile Approach to Budgeting. It's a great article and a good resource for discussing a performance-based approach during the pandemic. So if you get a chance, I would recommend taking a look at that article. And here it references a finding by Bain & Company that I thought was interesting, that predictable earnings per share trends, they only explained 1% of total shareholder returns. On the other hand, improving performance, such as return on invested capital and earnings growth, has 30 times greater impact. The article also has some great thought-provoking questions that I'm going ahead and telling you about. It's on the next slide, and we'll get to that in a minute. And I apologize if you can hear clanging spoons. I believe my son is in a music Zoom class right now. So apologies. But so what does budgeting for higher performance mean? It means we allocate resources from the strategy down. And you'll see here are the questions that the article mentioned. I'm not going to go over every one of them. This is more as a resource for you to go back to look at as you do a strategic plan and start budgeting that way. But I did want to point out 2 questions that I really like, and it's about innovation. And it says, using the priorities identified above, which would be whatever you identify in your action plans, whatever you find value in, where should resources go? How much should go to operations, such as running the business, versus innovations, which would be changing the business? And then what's the right balance for that? I have a client, a small foundation, but I wanted to share this example with you because I think it's short and simple. But the foundation, their main source of income is donations. So obviously, as you can imagine, those were significantly affected this year and probably into next year. What this organization typically does is bring together rare disease families with scientists and each other. They can collaborate, and it's usually, you know, a physical meeting. And they also write out a whole lot of grants. So during COVID, they sat down and everything changed. Their budget changed, and actually their values for this year and going into 2021 changed. Their strategy focused to be more on the children, the families. They weren't getting medical supplies. They needed more support. They just needed more. So they went down and took resources from all the other places and allocated them to this particular new strategy, I guess you could say. So I thought that was kind of a short and simple example of reallocating based off of a strategy. Whoops. So I thought this was a good quote. Among all of this is to never let a good crisis go to waste. Because this is where some of our greatest opportunities could come from. So use this time, you know, in the crisis to find those new opportunities. But in order to make sure our strategy-focused budgets are successful, is to not lose sight of the fundamentals. So here are some best practices to implement for our budgets. The first one, standardize your data and processes. So what does this mean exactly? It means making your methods and processes uniform or consistent throughout the company. This can be done by taking out manual methods and processes, because manual errors do create inefficient budgeting. Also consider cloud-based systems for more accessible data, and automate your processes. And like Heather was saying, are you getting, you know, if you're an Excel user, hopefully you are updating and getting the most out of your tools. If you are an Excel user and haven't kind of moved on past that, the next thing would be to focus on drivers. Now, since our focus has shifted to strategic success, our drivers need to come from areas where insight can improve business performance. Using a performance-based framework, we allocate resources to those specific objectives or activities. Also for our drivers, include non-financial data such as employee production rates, efficiency metrics, and average time to hire, customer support tickets, the list goes on. Also, continuously evaluate past performance. I think this would be a great time if you were in business to revisit 2007 to 2009 during the Great Recession, and see what your recoveries were like after that to plan for these coming years. If you weren't in business, consider looking at peer data, similar companies, if you can have access to that. Oh, I'm sorry, I went ahead of myself. And there's a polling question, if you see that. Also, involve your business unit leaders. They will be good for maybe coming up with newer ideas that you haven't considered, but also including them on setting budgets and plans. That helps keep them accountable. And with that, you need to make sure that they have access to reports that are relevant to their respective departments, so they can be monitoring too. Update the budget frequently. Once a year is just not enough, and it is not effective. Use your budget to plan continuously. Set up review cycles, whether that be monthly, quarterly, or whatever works for you, but do it more than one time a year. And revisit that initial annual budget that you made that sets the targets, and update those assumptions on a regular basis by using rolling forecasts. Rolling forecasts are great. They help us to project future results based on a combination of actual year-to-date results and then the original budget. And I have heard several clients approaching this upcoming 2021 budget say, you know, we have cut everything that we can think of. So what more can we do? Whoops, I gotta get out of this. Well, in addition to shifting our focus, like we've discussed, and hopefully we'll start doing that, there are some additional things you can do to further maximize your overall cost reductions. The first few ideas are probably the most common, and you may have already done them at this point during the pandemic, such as layoffs, rent or lease reductions, lowering your insurance premiums, and debt refinancing. But also consider taking a look at your advertising. You know, some companies may still be paying to run ads in the yellow pages, but also don't technically say no to advertising and marketing. Make sure that the marketing is strategy focused. For example, does your advertising gather information, maybe about customers or potential customers that could be useful when things turn around? Some ideas that are not so obvious would be consolidate your activities by combining events across multiple departments, like training days and celebrations, put those into one event. And then similar to activity consolidation, take a look at your departments and see if there are duplicated efforts across those departments or programs. So can we do the activity one time versus several times? The idea would be shifting some of the burdens to the more efficient location so that they can do what they are good at a lower cost to the company. Reduce spending on department management. So administrative activities typically don't change year over year. And if the investment and supervision can be done up front, we probably don't need that same level of management's time year after year. So because over time, administrative processes tend to stay the same, despite the fact that they may begin to become inefficient or ineffective, or maybe not even necessary. Also take a look at your administrative processes and determine the areas that may need to change. You know, you may have been evolving, and the need for data you've been collecting and using and processing, that may not even be needed anymore. Where are there areas in your organization that people are doing processes that maybe could be done electronically, and that their time is utilized in a more valuable place? So overall, strive to eliminate any work where the cost exceeds the value. Understand where the value in your organization lies. If you look deeper, it may not be in those traditional budget line items that we typically put our focus on. Because, when we get this right, not everything that can be counted counts, and not everything that counts can be counted. And I will hand it over, I believe, to Dustin for some closing thoughts.
Well, amazing how well you said that. You know, it's a bit of a tongue twister for me. So great job, Jackie. It was great to hear from you and to hear from Heather. So let's see, do I have control of the slides, Amy?
Yes, you do.
Okay, great. Gonna move on here. So I have a few closing thoughts with, it looks like we've got about 6 minutes until we hit the 50-minute mark of the webinar. We also do have some time for questions and answers at the end. If you'd like to ask a question that we can answer live, put it into the Q&A. We've answered a few questions in there already, but we could answer some questions live if you'd like to ask one. So be thinking about that. So just a few closing thoughts in the remaining time. Wanted to share a quick Excel tip. So what you see right here towards the top, I'm gonna get my annotator out here. So what you see here in the before section of this right here, well, you look down here and you see a traditional format of a budget report. And so it's got columns for actual results right here compared to budget amounts. And then you've got a variance column right here that calculates the difference between the two, just a simple subtraction equation. And then you've got a F or a U right here in this column. So saying whether the amount, actual amount is favorable compared to the budget, or a U for unfavorable. So this is a kind of your typical, your common format. The one I learned when I was in college was to do it this way. But what I suggest is putting a little more color in your report, which may make it a little easier to read and quickly spot where things have gone over budget or where things are under budget. So you can do this with the conditional formatting button, which you can see right here in the Excel ribbon. And when you click on that, you'll have several different options under there. So you can highlight cells at a certain amount threshold, or use color scales where you want different shades of red or green, depending on how much you're over or under budget. So if you click on this More Rules button right here, this option, that will give you a drop down where you have a lot of flexibility in choosing the colors you want and assigning what values you want those to apply to. And so that's what I've done right here. I've got a darker green because this is well over budget, and you'll see here's a dark red because this is this perhaps bad. You're pretty significantly over budget with your salaries and a little over budget with your meals. So maybe something to think about. If you want to improve your reports, can consider trying this conditional formatting in Excel. Okay, next slide. Controlling what employees spend. So another point here I have to share is I've seen a trend during the last couple of years moving away from employee expense reimbursements towards a more controlled credit card spend in companies and nonprofits. So what the traditional process is employees spend money from their personal funds and then they get reimbursed. And there's all kinds of problems with that. It's a cumbersome process. Expense reports may not get filed for a few weeks or a few months. So there's a big information lag sometimes. And employees may not follow company policy when they go out and spend money. They may go over budget. I've heard a lot of reports of this happening. So the solution I've seen many companies adopt is that rather than after the fact employee reimbursements, they're giving company credit cards to employees and then integrating that with software and enforcing budgets. So the advantages of this is that you can request and approve budgets from your phone app, and you can get real-time information the second a credit card is used, that a transaction has occurred, how much and where. And all of this integrates with accounting software, which is really nice. So this is something you may want to consider if employee reimbursements are a contributing cause to things going over budget. And here's an example right here. You can see on a phone app, a simple request and approval process for with this mobile app on controlling your spend. So one more slide I'd like to discuss here. So I thought Jackie gave some great points on watching your expenses and finding ways to cut your expenses. But I think that's only half the equation. There's talk about your revenue as well. So if you want to grow your business and improve your cash flow, it's often more effective to focus on top line revenue. In my experience, I've seen companies innovate and find ways to grow their business by increasing revenue, let's say 10%, 20%. On the other hand, I've seen companies put their primary focus into pinching pennies and cutting corners to cut expenses. And sometimes they're able to do that, but maybe they only get 5% or less out of that. And sometimes it has unintended consequences. Another mistake I see small businesses commonly make is that the primary report they run to evaluate customers and monitor collections is the accounts receivable aging report. So I feel like that report certainly has its place, but there are other sales and customer metrics that you can monitor. Let's say the number of new customers, repeat sales, customer retention, and collection effectiveness. So days sales outstanding is just one example of a metric that's commonly used in valuations. And when it's monitored consistently, it can help tell the story of how effectively a company is collecting receivables and how you compare to others inside of your industry. Another polling question looks like the last one. So go ahead and take care of that. And when you look at reports, such as the one you see here at the bottom here of the screen, at a customer level, you can see which ones might require more collection efforts or which ones might require a little more attention to get a repeat sale from them. So it takes a combination of several different metrics to see the full picture, and there's software out there that can take this information out of your accounting system and generate these reports. So with that, we're just over 15 minutes and going to see if we have any questions we can answer. Heather or Jackie, I don't know if you see any questions there you'd like to answer live.
Yeah, so we're getting a lot of questions, Dustin, about what our favorite cash flow and forecasting softwares are. So I don't know if we want to kind of name a couple or what your thoughts are on that, because just so that everybody webinar knows, we do work with a lot, and typically we always want to have a conversation with you more about your business and more details so that we can make some of those recommendations, because there are so many to choose from, which I'm sure you all know already.
Yeah, that's exactly right. And it's going to depend a lot on what accounting system you're using. If you're using a big ERP like NetSuite or an Intact, they have their own modules typically for these kinds of things. So that may be something worth looking into if you're on one of those ERPs. If you are on a smaller accounting system like QuickBooks or Xero, for a smaller business, there are a number of tools that you could look into. Just to give you some examples, we have used Dry Run is one that we've used, and with some clients. Cash flow tool by Finagraph is another one. Works very well with QuickBooks on a kind of a customer and vendor basis. And there's other tools out there as well for maybe more of a high level cash flow forecasting look. There's Fathom, Giraffe. They can do future cash flow statements. So a number of tools. If you're using QuickBooks, you could go to the apps.com, the app marketplace, and search for cash flow in there. You'll get 26 results. So you've definitely got a lot of options to look at for your for cash flow software.
And just to add on to that too, we're really happy to have that conversation, that initial conversation with anybody that wants to just talk it through a little bit more. I think our contact information will pop up towards the end of the presentation. So never hesitate to pick up the phone and call or email, and we would love to talk more about your specific situation.
Okay, well, thank you, Heather and Jackie, for presenting. Thank you, Amy, for coordinating and putting this together.
We do have a couple more questions if we have a minute.
We do. Oh, yeah, go ahead.
So Jill's asking the cash flow equation, and if we could just show that again. I think that's towards the beginning of the slides. But Jill, the slides are available for download, and so the equation will be shown on those. So if you go into the chat, I think towards the top, there will be the link to download the slides. And then Sandy's asking what software integrates with the credit cards that enforce budgets. And Sandy, that software that we showed was called Divvy, D-I-V-V-Y.
Yep, that is the software I was showing in those screenshots is Divvy. They're here in Utah, neighbors of mine. There are other options out there. TeamPay is one, and Expensify also has put out has a new credit card program that's similar. So several options there as well. There's many companies the last couple of years that have been doing very similar things.
And if they haven't checked out the chat, there are some links that have been posted from the presentation. So make sure that you look through the chat and grab any of that information that you need.
So Mark asks if we have a standard small business data collection form to ascertain best fit for cash flow software for a particular company. We don't right now, Mark, but that is a great idea and something that we'll take back to our team. Maybe we could put something together for that to share. And Michael asks, I currently have a fixed annual budget to fully use the rolling forecasting. Does this mean restating the budget at a certain frequency, such as quarterly? And what frequency do businesses generally use when rolling forecasting?
So I just make it part of my monthly financial process. It's not necessarily
But just thank you all so much for attending, and thank you to our presenters. And if you don't have any other thoughts, have a great day, everyone.